Something big is happening, and Warren Buffett's $90 billion equity sale is a signal for what is coming. When the Oracle of Omaha makes such a big sell-off, it is time to pay very close attention. We have never seen him make such a big bearish move before, and the market is beginning to respond with a downward trend. Luckily for us, the CEO of Berkshire Hathaway gives very clear explanations for why he is selling so much stock. Hi, my name is Yernar, and in this video, we will discuss the reasons behind these sales and take a closer look at how they might affect you, because this information is important for investors of all levels. So, make sure to hit the like button and subscribe to the channel. What shocked financial analysts was the amount of Apple stocks Buffett sold this year alone. This decision to sell a significant portion of his Apple holdings has certainly caught many off guard. After all, Apple has been his largest investment for years. As we entered 2024, it was astonishing to see that Apple accounted for 50% of Berkshire Hathaway's portfolio, but the investment giant has sold over half of that holdings, which amounts to about $90 billion cashed out. It is not surprising that his move has caused concerns.
But when you get those headlines about Warren Buffett, right, selling that much Apple over the course of the last 6 to 8 months, that could be concerning.
Do you know that Buffett has to pay $15 billion in taxes for the Apple shares he sold? To put this into perspective, this tax bill alone is higher than Coca-Cola's entire quarterly revenue, which was around $12.4 billion in the second quarter of 2024. Selling such a large amount of stock and willingly paying this much in taxes suggests that Buffett sees significant value in holding cash right now. Needless to say, $15 billion in taxes is a lot of money, and if Buffett is paying that much to get some stocks off his portfolio, then it is time to pay close attention to why he is letting go of so much money. Not only did he sell Apple shares, but Mr. Buffett also excluded Apple stocks from his list of stocks he plans to hold long-term. His position was set on Coca-Cola and American Express being his long-term positions. This has made investors of Berkshire Hathaway ask why Apple was excluded from his long-term position.
Last year, you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions, and you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
Buffett's journey with Apple began in 2016, and over the years, he steadily increased his stake, recognizing the company's potential for robust growth and profitability. By 2020, Apple had earned its place as one of the four jewels of Berkshire, alongside their insurance operations, BNSF Railroad and Berkshire Hathaway Energy. This is why the sale of over 389 million Apple shares in the second quarter of 2024 has raised more than a few eyebrows. Buffett is known for his long-term investment strategy, so his decision to sell such a substantial amount of Apple shares, even as the company remains profitable, indicates a shift in strategy. But that is only half the story, because the total number of Apple's shares Buffett offloaded so far in 2024 is a lot higher. Before the Q2 sale, Buffett had sold some of his Apple equity in Q1, which made a combined sale of 510 million shares in the first 6 months of the year. That is 56% of the total Apple shares Berkshire Hathaway holds. The primary motivation behind this sale appears to be the current low corporate tax rate of 21%, which Buffett has wisely used to realize substantial profits. With the Biden administration proposing a tax rate increase to 28%, Buffett's move can be seen as a strategic preemptive decision to secure gains before any potential tax hikes come into effect. While this speculation is valid, it is not the entire reason why Buffett is selling so many Apple shares. We have to ask, why Apple? Apple's growth has slowed down, and the company is facing stiffer competition, particularly in crucial markets like China, making the stock less appealing than it was during its rapid growth phase. The baseline is that Apple is not growing anymore. The tech giant has seen its growth stall over the past 2 years. After a period of remarkable expansion, Apple's revenue has declined. In 2023, Apple's annual revenue was $383.2 billion, down 2.8% from 2022. Based on June 2024 data, revenues are up just 0.43% over the past 12 months. These numbers are no longer what the company once showed. Meanwhile, China has been making significant strides in the tech industry. positioning itself as a formidable competitor on the global stage. China's tech sector has seen explosive growth, driven by substantial investments in research and development. From 2018 to 2023, China's R&D expenditure increased by nearly 70%, leading to advancements in cutting-edge technologies. In 2023 alone, China spent a mind-blowing 3.3 trillion yuan on research and development in tech. That is 458 billion in US dollars. Chinese companies like Huawei, Xiaomi, and SMIC are not only catching up, but in some areas, surpassing their Western counterparts. For instance, SMIC, China's top chip maker, reported strong revenue growth in the second quarter of 2024, driven by increased local demand amid geopolitical tensions. This growth is part of a broader trend where China is leveraging its massive domestic market and government support to foster innovation and technological self-sufficiency. Does that mean Warren Buffett is investing in China? The answer is no. He has investments in BYD, which is a global leader in electric vehicle manufacturing. The company is doing extremely well, even beating Tesla's sales records on several occasions. In the fourth quarter of 2023, BYD managed to surpass Tesla in global EV sales for the first time. This was a significant milestone, highlighting BYD's rapid growth and its ability to compete with the established leader in the EV market. However, the competition remains fierce. In the first quarter of 2024, Tesla reclaimed its position as the top EV seller, delivering 386,810 all-electric cars, while BYD sold 300,114 EVs. Despite this, BYD's sales grew by 13% year over year, narrowing the gap with Tesla. In the second quarter of 2024, Tesla again held the lead, but BYD narrowed the gap to less than 18,000 vehicles. And CNBC is forecasting that BYD will surpass Tesla in electric vehicle sales in 2024. So yeah, the Chinese EV maker Buffett invested in is growing fast and has been one of his best investments. But guess what? Warren Buffett is selling his BYD stocks too. With this, we can conclude that something bigger is happening here. He is not selling just to make a profit. He is selling because he sees what's coming and he is buying a cash hoard, the largest liquidity any investor holds in the world. As of the latest reports, Buffett's Berkshire Hathaway is sitting on a staggering $277 billion in cash. This is a record amount, and it's a result of the massive stocks recently sold by Buffett. So, why is Buffett amassing such a large cash reserve? A few theories are floating around. One major reason is his cautious approach to the current market conditions. Buffett has described the markets as exhibiting casino-like behavior, which suggests he sees a lot of speculation and overvaluation. By holding onto cash, he's positioning Berkshire Hathaway to take advantage of potential opportunities that might arise if the market corrects or if there are attractive acquisitions to be made. Warren Buffett has his reasons, and they are broader than you imagine.
Under current conditions, building the cash position, I think when I look at the alternative of what's available in the equity markets and I look at the composition of what's going on in the world.
Here, Warren Buffett revealed that his decision to stock up more cash than holding stocks is because of the current conditions, and he suggests that when he looks at the alternatives in the equity market, there are no good or safe investments to move his money into. He hinted that this is because of what is happening on the global stage at the moment. Most likely, he is implying uncertainties in the global economy and uncertain foreign policies, as there are a lot of tensions between nations at the moment. Apple's business has been affected by these tensions and uncertainties, and there is a possibility that things won't ease up anytime soon. But even more worrisome for Buffett is what is happening in the United States regarding taxes and possible government policies that may be unfavorable. Warren Buffett has been particularly vocal about his concerns regarding the United States' escalating deficit.
They may decide that someday they don't want the fiscal deficit to be this large because that has some important consequences, and they may not want to decrease spending a lot, and they may decide they'll take a larger percentage of what we earn, and we'll pay it. And we always hope at Berkshire to pay substantial.
With the government's debt now standing at an astonishing $35 trillion, Buffett's worries are not unfounded. He has often highlighted the potential risks associated with such a massive deficit, fearing that the country might be approaching a breaking point. Buffett's apprehensions are rooted in the belief that the government may soon be forced to take drastic measures to reduce the deficit. One of the most likely actions, according to Buffett, is the imposition of much higher taxes. The rationale behind this is quite straightforward. Reducing spending is politically challenging and often unpopular, so the alternative is to increase revenue through taxation. This means that both American citizens and corporations could face significant tax hikes soon. It is important to point out that Buffett had made suggestions on how to solve this problem, but it seems he is accepting that the government will not make the decision that would ease the country out of this problem. In his discussions, Buffett has emphasized the importance of maintaining the nation's creditworthiness. He draws parallels between personal financial habits and national fiscal management, suggesting that just as individuals face consequences for poor financial practices, a country can suffer from fiscal mismanagement too. The consequences of not addressing the deficit could be severe, potentially undermining the United States' standing and credibility in the global credit market. Buffett's concerns are not just theoretical. He has pointed out that huge and entrenched fiscal deficits have real consequences. While he remains optimistic about the long-term resilience of the American economy, he acknowledges that the path to resolving the deficit will likely involve tough decisions and sacrifices. His pragmatic view is that higher taxes are a probable outcome, as reducing spending is often met with resistance from various interest groups and political factions. Despite selling so much of his stocks, Apple remains the largest share of his portfolio. The remaining shares are still valued at around $89 billion. Buffett is cutting back on the massive 21% taxes he's paying from the stock's interest to the government. The issue isn't the taxes themselves, but the uncertainty of what the government may do next.
We are paying a 21% federal rate on the gains we're taking in Apple, and that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And
the Biden administration has proposed several tax reforms that could significantly impact both corporations and high net worth individuals. These proposals include increasing the corporate tax rate from 21% to 28%, implementing a minimum tax on billionaires, and raising taxes on capital gains for those earning over $1 million. Additionally, there are plans to quadruple the tax on corporate stock buybacks from 1% to 4%. These proposed changes have created a sense of unease among investors, including Buffett, who is known for his meticulous risk assessment. The uncertainty around how these tax policies will be implemented and their potential impact on the economy has led Buffett to adopt a more conservative stance. Moreover, this money isn't just sitting idly under a mattress. It's invested in short-term bonds, yielding around 5 to 5.5%. By holding cash, he maintains flexibility and reduces exposure to potential market volatility that could arise from these tax changes. It also allows Buffett to be prepared for any opportunities that may arise, such as undervalued assets or distressed companies that could become attractive investments in a volatile market. So, if we return to the question of whether Apple is a bad investment, and if that could be the reason why Buffett is selling so many shares, the answer is that he doesn't consider them a bad investment. He believes in the company just as much as he does in the other stocks he owns. His concerns are broader in scope, and they are likely to impact the average American in more ways than we realize now. But what we can do now is to hit the like button and subscribe to the channel if you haven't done that already. Thanks for watching, and see you in the next one. Bye-bye.